Hey, what's up guys? John here. What is a second mortgage and how does a second mortgage really function? Well, a first mortgage is the mortgage that you use to buy the property. Generally, the bank will put down 80% and you, the borrower, would hypothetically put down 20% as a down payment to buy that property. That would be the first mortgage. And the first mortgage, they have the first right of refusal to move forward on a foreclosure in the event that you stop paying your mortgage. However, a second mortgage is second in line, so they do not have as much authority, yet they take more risk, and because of that, they generally demand a great credit score, usually above 630, but preferably above 700, especially during these uncertain economic times. They generally tighten up their lending standards. So you want to have a good credit score to be able to ensure you're going to get a good interest rate and as much money as possible from the property. Now, when you are going to get one of these mortgages, one of these second mortgages, they look at your debt to income ratio. And what is that? Well, a debt to income ratio is if you're making $100,000 a year, they generally do not want to lend more than 43% of your overall gross monthly expenses. So if you have $100,000 a year, they don't want to see more than $43,000 per year going out towards expenses. So they want to see small expenses, they want to see good credit, a strong ability to pay back, and they want to see equity in the property. Now, what is equity? If you have a $500,000 property and you owe the first lender on that property $250,000, that means you have $50,000 in equity. They generally would lend you $100,000 to $150,000 on top of your $250,000 to ensure that you have at least 20 to 25% equity remaining in the property, because that equity is going to ensure them peace of mind that you have money on the table and you're not going to just simply walk away. So they want a strong ability to pay back the money. They want to make sure that you have equity in that property and that you are not to your teeth in debt. So when you have bad credit, just know that what they are intending to do, they're looking to underwrite more risk on that borrower because they are deemed higher risk. So what does that mean? That there's a higher probability that they are going to have to go to extreme measures to potentially get their money back. And so for that, they're going to charge you higher interest and they're going to lend you less money. So what you want to do is you want to have a great credit score to open up the doors to many different lending options. So if you need help fixing your credit score, we would love to give you a free consultation to show you how we can help you get access to more money and cheaper lending options. More information can be found below this video.